Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Monday, May 24th, 2021, and I'm pre recording this Trading Places Live for Tuesday, May 25th. Uh, Currently, futures are up a little bit. We've got the Dow Jones futures up about 50 points, S&P 500 up about 7.5, and the NASDAQ futures up a little bit more, up about 22, a little bit higher on a percentage basis. Um, but overall, it looks like maybe the market will continue the rally we saw on Monday. We're going to get into all of that in just a minute. I do want to walk you through today's agenda. So we are going to start out with the daily market recap, as we always do, jump into talking technically. Then I'll go through relative strength, take a look at some of the sectors today, momentum sleepers, and maybe how you can find some of those stocks that are just kind of sitting, waiting to surge again to the upside. Then we'll get into earnings spotlight. Even though earnings have wound down quite a bit, there are a number of companies that will be reporting throughout the week, and we'll take a look at some of those. And then we'll wrap things up with the three you must see. Let's go ahead over to earningsbeats.com. For those of you maybe that are new to Earnings Beats, I always just like to point out that we do have a free newsletter. It is our Earnings Beats Digest. It's published 3 times a week, Mondays, Wednesdays, and Fridays. The articles are sent out usually a little bit before the market opens. So some of them are trading ideas. So you may want to take a look and consider some of those before the market opens. All you have to do is type in your name, email address, hit that subscribe button, and we will get you set up. There is no credit card required. It's completely free. You can unsubscribe at any time. It's really just an educational newsletter with some trading ideas thrown in from time to time. So again, just name, email address, hit that subscribe button, and you can join many thousands of folks that enjoy our Earnings Beats Digest newsletter. All right, moving on to the daily market recap. Dow Jones Industrial Average on Monday up 186 points. The S&P 500 up 41. The NASDAQ up 190. So on a relative basis, there's your winner. Mid caps also up about close to 0.5%. Same goes for the small caps. So across the board, pretty good action, moving back above all of our key moving averages across the board, really. The mid caps, the closest to not making it back up above the key moving average, but you can see there 2702 versus the 20-day moving average at 2701. So literally all 5 now have climbed back above the key moving averages. Now, I would say until we're able to see a little bit more confirmation, my gut feeling is, and the odds would suggest, that we're probably going to see more sideways consolidation. But I'm going to get into talking technically in just a minute and look at the S&P 500. And I think there is a chance maybe that we are beginning to start another leg up in this secular bull market. But we'll get to that in just a minute. As far as the sectors go, communication services up almost 2% on Monday. So that was your winner there from a sector perspective. But we did have 3 other groups that gained at least 1%. Technology, nice to see technology rebounding at the end of last week and into the early part of this week. Real estate trying to make that breakout, trying to get through $43. Not quite able to close there today, but we did still gain a little over 1%. And then energy bounces back a little bit off that 20-day moving average, jumping about 1% today. The laggard utilities down almost 0.2%, just simply sideways consolidating after posting that high back in April. On Tuesday, as far as economic reports go, we have the March Case-Shiller Home Price Index due out. The expectation there is for a rise of 1.3%. February saw a rise of 1.2%, so a slight move higher there. March FHFA House Price Index expected to climb 0.9%. February also climbed 0.9%. April new home sales expected to come in at 950,000 units, 957,000 units. March was 1,021,000 units. So we're looking for a decline there. And then finally, to wrap up economic reports on Tuesday, May consumer confidence due out at 10 a.m. 119.0 is the estimate. April was 121.7. So we're looking for a slight pullback there in consumer confidence. Looking at the 10-year Treasury yield, just sideways consolidation. We really haven't seen the 10-year make a move since that March high was established at about 1.75%, put in the double top, negative divergence. We've seen all of that play out, and now we simply consolidate and we're waiting for the next move. I believe it'll be to the upside. I think we're going to see this move, and I think there's a good chance over the next few weeks to maybe a month or two, I think we're going to approach that 2% level on 10-year Treasury yield. I think that will continue to favor financials and industrials, which have done very well as rates have been rising throughout the past 6 to 8 months. And I think that's going to continue, but we'll see. First step is which way do we go out of this sideways consolidation? I believe it's going to be the upside. I think we will break out above 175 and close above 175 before we move down and close below 150. Just my opinion. All right, moving on. How about talking technically? I wanted to pull up the S&P 500 because I said I think we could be poised to maybe rally again, and I want to tell you why. First off, I wrote in Chart Watchers over the weekend. If you had a chance to read that article, then you'll know what I'm talking about here. If you haven't had a chance to read it, I would go back and take a look at it. But I was just talking a little bit about the history of the market and how the market does extremely well heading into earnings season. Just before earnings season, the market anticipates strong earnings. And so prices reflect that before the earnings start coming out. So just take a look at the end of March through the first 2 or 3 weeks of April. It was almost a steady move to the upside. From the low here in late March, we were down at about 38.50. And by the 19th of April, which was just shortly after the banks started reporting, we had reached almost 4,200. So that was probably about a 9% move in literally just 4 weeks, 3 or 4 weeks. 9% is the average annual return on the S&P 500 since 1950. And we were able to accomplish that literally in about 3 or 4 weeks. So that was the first thing. After that, we needed to consolidate. And that's what the S&P 500 has been doing. It went sideways, false breakout to the upside, false breakdown to the downside, taking out these prior lows. We came back up, filled this gap, went back down, put in a double bottom. And now we've come back up and we've cleared this intermediate high between these two, this double bottom. That's usually a pretty good sign. And then when we did pull back, we held the rising 20-hour EMA. If you notice the last move to the upside, when you trend, you tend to bounce off of that 20-hour EMA. Just like back in March when we were trending here, we were tending to bounce off of that 20-hour. Here, when we're going sideways, notice the moving averages do little to support price action. And now, since breaking back out above that mid-May high, we went back, we held that 20-hour, and now we've bounced to a new high, and you can see the 20 is now above the 50. So we've got this configuration again as though we're trending higher, but we haven't broken out yet. So I think that the odds are suggesting that maybe we have a better chance to make this breakout coming up. I'll also point out that historically, May 25th through June 5th, or maybe May 26th through June 5th, is a very bullish period for the S&P 500 historically. And we've got that period coming up after sideways consolidating. So if we can get this breakout above that high in the second week of May, you know, you start seeing the S&P 500 back up to 4230, 4240, setting all-time highs. Just keep in mind that that would coincide with a very bullish historical period. Something to keep in mind there. All right, let's keep moving on here. I'm going to go into sector analysis or relative strength. I want to show you the various sectors on a relative strength basis. And I want to start with technology because technology is starting to show some strength, but I don't believe we're out of the woods yet. We had a super strong move for a long period of time. Technology was leading the secular bull market. And really over the past 10 months or so, we have been seeing, maybe 9 months, we've been seeing much more sideways relative action in technology. And if we look back just over the last 3 months, it's been more downward action. So yes, we have started to show a little bit of relative strength here in May, but you can see that relative 20 week EMA has fallen below the 50-week SMA, and that's not a good sign. We also have seen the relative PPO drop in the negative territory. So yes, we're strengthening here, but I do not believe we are out of the woods yet on technology. So if we are truly beginning to uptrend again, I think we probably need to see a little bit more strength out of technology, although the April advance came with technology declining. So, anything's possible, but technology is the largest part of the S&P 500. So it's really difficult for the S&P to do anything meaningful to the upside if technology is not going along for the ride or leading. Consumer discretionaries had very little bounce. And you can see here, we are right now at a relative low, a 1 year relative low on consumer discretionary, which quite frankly, I'm surprised. I said back at the beginning of the year, I thought consumer discretionary would be one of the better performing areas in the market. And I do think we're going to see it return to a relative leadership role in 2021. But right now, it's pretty clear that consumer discretionary is out of favor. And now we have been in negative territory for about 3 months, all going on 3 months, the XLY versus the S&P 500, the relative PPO. So got some issues still in the two bigger groups within the S&P 500. Communication services, another area, another aggressive area within the market, actually trying to break to a 2-month relative high, starting to see some pretty good action here. So I'm still okay with this group. Industrials are fine. We have pulled back on a relative basis the last couple of weeks, but I still think this uptrend, relative uptrend, is in play. The absolute price action has been tremendous. So I don't have any issues at this point with industrials. Financials, we got a couple of things here going on. Number one, we had a huge move, so we were seeing a little sideways consolidation. Relative strength has been very solid, almost off the chart, literally, the past several months since the positive vaccine news came out in November. This has been one of your leading groups, but it has, just started to flatten out here a little bit in May. I think we'll see further leadership down the road. Moving on, healthcare. So we get away from the aggressive areas, move into the more defensive areas. You got healthcare rolling over. I would watch this 20-week EMA. You can see we've done this before where we've gone through the 20 and then we failed, moved to new lows. We've done this twice now. So I'm watching this to see whether or not we hold this 20. If we can hold the 20 and then start shooting back up to the upside, then I think healthcare has a chance to lead this summer. And I believe that healthcare is going to be strengthening. I like this relative PPO, even though we've seen the price action continue to go lower and lower. This is probably the best the relative PPO has looked in a while. So I think the momentum is beginning to shift a little bit here in this group. Consumer staples, still struggling here. As long as we're below that 20 and the 20s below the 50 and the relative PPO is negative, I think we've got to be careful here. On an absolute basis, you can see everything is, for the most part, going higher, but not everything can lead the S&P 500. And that's the problem. We've got a secular bull market where a rising tide lifts all boats. So we're seeing a lot of strength in a lot of areas. But on a relative basis, consumer staples are not leading. And I'm not looking for them to lead unless the market goes through a lengthy period of consolidation. Real estate, kind of in the same boat, although real estate has shown a little bit more relative strength. You can see that relative PPO now turning positive. We're now above both the 20 and the 50, and the 20 is trying to cross the 50. So real estate looks better, but I'm still not looking for real estate to be a major leader. I think we'll roll back over here at some point in 2021. So it's not one of my favorite groups, but if you stick with some of the leading stocks within this group, I think you'll be okay. Utilities, the last defensive group we're going to talk about here. This has been probably the weakest area of the market. But again, we've been strengthening here on an absolute basis. We're now threatening that February high from back in 2020. Haven't broken out yet on an absolute basis, but we have recovered everything we lost from the pandemic. But the S&P is way above where it was in February of last year. So that's why utilities are showing this relative weakness. I don't see this really changing in any meaningful way for a while. So I'm not a big fan of the utilities group. Energy and materials, these are two groups that are going to continue to depend on the dollar weakening. Right now, energy is showing nice relative strength and nice absolute strength. Materials, I'll pull that up. Materials, one of the strongest areas for over a year now. We have been climbing. Materials look good on a relative basis, obviously on an absolute basis as well. But I do think these last two groups that I'm mentioning, energy and materials, they're going to rely, I think, in order to continue to lead, they're going to need to see the dollar continuing to weaken. I don't believe the dollar is going to continue to weaken, but it's certainly possible. So if the dollar, and I'm watching the US dollar index, the dollar sign USD is the ticker that you can use. So if we pull this up and let's just go back a ways, let's go back monthly, 15 years. You can kind of see this low down here that coincides with this double top highs. So I'm thinking right around that 88 level is where the dollar needs to hold. If it holds and it starts turning back to the upside, I think that's when energy materials may begin to lose some of that relative leadership. Something to keep in mind anyway. All right, let's keep moving. We do have momentum sleepers. I just mentioned the financial group, and I just wanted to bring up the daily chart and then the hourly chart. So we have financials moving very strongly to the upside. AD line looks good, continues to strengthen. I think this chart looks fine. We are consolidating after setting that high back on May the 10th. So we're just pausing right now on financials. Nothing wrong with that. If we look at an hourly chart, you'll see that we had the huge move from April, late April into the early part of May. And then since then, we've just seen this sideways consolidation. Double bottom down here at about 36, a little above 36.50. Eventually, the upside will be tested closer to 38 and a quarter. That may be coming sooner rather than later. But ultimately, what we're looking for is a breakout above that 38 and a quarter level. And I think we'll get it. But looking at if you want to try to find momentum sleepers, I think an area like this makes sense because the group is kind of, was a momentum group, high momentum, bullish momentum, but it's paused. So we've got this momentum sleeper right here in the XLF. So what I did was I went back and I looked and ran a scan, and this is how I ran my scan. So I'm looking for stocks with 50-day volume, average volume, daily volume of at least 300,000 shares. So I want to make sure I'm getting a liquid stock. Scooters right now less than 95, but 10 days ago greater than 95. Now the reason I picked this 95 and why I picked 10 days ago, if you look at the chart, the XLF, this high was 2 weeks ago, which is 10 days in scan engine language. 5 days is a week. So that's why I ran the scan and was looking 10 days ago at the scooters. When financials were at a high, any stock within this space that had a scooter over 95 could be included in this, in the results. Then I'm looking for the scooter now to be under 95. So in other words, it just pulled back a little bit during this 10-day period. And then, of course, group is the financial sector. And then you could run this, which I did, and it came back with two results: Babcock and Wilcox Enterprises and East West Bancorp. And if you look at these two charts, I think you understand why it comes up in the scan. So Babcock and Wilcox Enterprises, we were at a high at the beginning of April, pulled back, end of April, getting close to the high, pulled back, and now we're strengthening. But it looks to me like a little bit of a triangle, which is a continuation pattern. This is a symmetrical triangle, lower highs, higher lows. So we're squeezing, and that tends to follow an uptrend, which is what we see here. And this is really what many momentum sleepers would look like, where you're simply consolidating after a prior uptrend. So I think this stock looks good. Ultimately, I would be expecting a breakout back up above that $10 level. In the meantime, maybe we continue to consolidate. The other stock on the list, East West Bancorp, This one you can see printed a high back in March, basically tested the high back on May 10th. So it was 10 days ago, and has since pulled back. So we've seen that scooter score drop a little bit, but there's nothing wrong with this chart. After an uptrend, it's sideways consolidating. This is another one that I would expect is going to break out rather than break down. So I think we're going to see this breakout above even this high up here at about 82.5. I look for East West Bancorp to take that out probably within the next month, maybe sooner. But EWBC, I think, looks pretty good to me. Now, we could, go back in here and we could change this. If you wanted to look at a different group, you could basically run this same scan. And instead of financials, a group that's been kind of struggling a little bit lately here has been materials. So we could just add materials. And instead of running it against financials, haven't done this, so we'll see what comes up. But we'll run this, get scan result. And here you've got 7 companies to choose from. And we can sort it by scooter. And you can see, let's just pull up the one here, the high one. TX is pulled back at its 50-day moving average just a couple of days ago, consolidating. Very nice volume trends on this move to the upside. So I think TX looks pretty good. So that's your momentum sleepers. Let's move on to earnings spotlight. So on Monday afternoon after the close, we did get a couple of reports out. One was Nordson, NDSN, and this is in the industrial machinery space. And the AD line's not been very strong, but we did just recently have a breakout to a new high. And then we've pulled back heading into the earnings report. They actually reported really nice numbers, $2.12 earnings per share. Market was only expecting $1.65. Stock was up more than 4% after hours. So probably looking at about $8 or $9 to the 210, 211 area. Let's watch to see if we can get this confirmed breakout above 215. Otherwise, I would expect maybe a little bit more consolidation. Another company that reported after the bell, very strong numbers, CRMT, this is America's Car Mart. They too up almost 5% in after hours. They reported earnings of $6.19. The market was expecting $2.69. So the stock up almost 5% after hours, which would be another $7.50 roughly, which would take this stock up to about 157 and change. Got to get through about 162, 163, actually maybe even a little higher than that. Let's see what this high is. 164.99. So essentially 165 would be your breakout level on CRMT. It doesn't look like we're going to get that at the open. So we'll see whether or not we can move through that 165 area by the close. There are some other big reports coming up later this week. Probably by the time you listen to this recording, AutoZone will have reported. That's AZO. They are expecting $18.93. Probably a negative divergence. I don't have PPO up here, but I'm assuming off of that move right there, probably had a negative divergence, lower PPO, which likely is the reason why we have seen this pullback to the 50-day moving average. That should be resetting the PPO close to the center line. And I wouldn't be surprised to see the stock go higher from here. So I'd be looking for pretty good numbers. This stock relative to the specialty retail group was at a 52-week high just a couple of weeks ago when we topped. So I think we'll probably see a better than expected report here on AutoZone. And then coming up later this week, so many companies. Tuesday after the close, I'll just go over a couple of these. Intuit reports. Looking at this, you can see the AD line strong, just recently broke out again. And this is in software, which is not at a breakout level. It's down from its recent high. So the fact that Intuit's breaking out tells you it's been a strong relative performer. And here you can see it. Really nice action. So I would expect, and I think a lot of folks that are investing in software are certainly hoping that Intuit comes through with their earnings report after the bell on Tuesday. Agilent will be reporting as well. Agilent's in the medical equipment area. AD line, kind of suspect. I think the stock, with this double top, rising lows, a little bit of an ascending triangle kind of look to this chart. So a breakout would measure up about probably about $25 above the 137, 138. So this could go through 160 on a breakout. So watch for that. Of course, we'd want to see confirming volume on that breakout as well. Then there is Zscaler, ZS. AD lines remain strong, even though price action's been a little weaker. I think we've got really good support, though, in this area right at about the 160 level. We got gap support that goes down just below 150, but I think 158, 160 is probably going to hold this stock to the downside. On a relative basis, it has been struggling versus software ever since it made this high back in February. So it's just been doing what a lot of growth stocks have been doing, which is struggling. Interesting, though, to see how not only how they report, but how the market reacts. So if the numbers are just so-so, or if they beat, let's see if we continue to see weakness in these technology companies after they report, or are we beginning to see a change? That is something I'll be looking at. And then in addition to a number of economic reports in the home construction area, I mentioned those earlier in the program, Toll Brothers reports their earnings after the bell. So home builders are going to have a lot to pay attention to tomorrow. And it'd be interesting to see how they react to all the economic news and also to Toll Brothers report after the close on Tuesday. This is a stock that I think had been doing very well, looks pretty strong relative to its peers, had set a high, went back, tested the 50-day, and I think is poised to climb from here. So I'd be looking for a pretty good report out of Toll Brothers, and then we'll see what kind of reaction we get. All right, let's move on to the three you must see, and then we will wrap up today. I went back into the 52-week highs, and I found three stocks that I thought were very interesting. First one, Equity Residential Property Trust. So if you're looking in the real estate group, which I showed earlier, is beginning to show some nice relative strength right now, why not go with one of the stocks that's been showing leadership qualities? When it set its high back in March, it was at a 52-week high or close to a 52-week high relative to its peers. It went through this period, sideways consolidation, and then we just broke out on Monday with pretty solid volume, a strong AD line, and relative strength starting to turn back up again. So this is one I would expect to do well. Now, again, I'm not really into the real estate area, but if I wanted to take on maybe a little less risky of a position, I think EQR does look pretty nice here. Next up is CNC. So we're going to move into the healthcare providers area. Look at the top here, 72. Here's the top at 70. Here's the top at 71. Finally, this week, well, late last week, and then on Monday, nice move to the upside, breaking out, setting new highs, good volume. AD line starting to rise nicely again. Relative strength now at about a 4-month high. So this is a stock that definitely is strengthening, and I like that. Now, here's one that maybe I would just offer up a little bit of a warning on. CHRA, Chara Solutions. This is a much smaller company, only traded a couple 100,000 shares, so be careful. But anytime I see a stock move up like this and print a new high and then fail to hold the breakout, I think it's probably going to weaken. So look for that in the near term. All right, that's it for me. Appreciate everybody tuning in. I will be back over at earningsbeats.com for your next Trading Places Live, which will be on Wednesday morning. That will start at 9 a.m. Eastern as well. Everybody have a great day on Tuesday, and hopefully see you on Wednesday. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.